because when it comes down to it, your biggest risk is with that tenant. And do not underestimate this risk. If they are a good tenant and pay their rent on time, respect your property, and follow all the rules in the lease, they are worth working to keep on. The most time spent and money lost for landlords is replacing that tenant. Welcome to your Landlord Resource podcast. Many moons ago, when I started as a landlord, I was as green as it gets. I may have had my real estate license, but I lacked confidence and the hands-on experience needed when it came to dealing with tenants, leases, maintenance, and bookkeeping. After many failed attempts, fast forward to today, Kevin and I have doubled our doors and created an organized, professionally operated rental property business. Want to go from overwhelmed to confident? If you're an ambitious landlord or maybe one in the making, join us as we provide strategies and teach actionable steps to help you reach your goals and the lifestyle you desire, all while building a streamlined and profitable rental property business. This is your Landlord Resource podcast. Well, hey there, landlords. Thanks so much for tuning in to the Your Landlord Resource podcast. I'm Stacy, and I'm here with my co-host, Kevin, also known as my business partner, who I happen to share my life with.
Yep. Living, working, raising kids, doing all the fun stuff right alongside you.
Yeah, it's not too bad, though. I think we've done a pretty good job of managing all that chaos.
Oh, absolutely. I mean, we complement each other real well. We've got a lot of comings and goings and often too many balls in the air. But I guess we've worked pretty hard to be organized and schedule in some downtime here and there.
Yeah, we have. I could definitely use a lot more of that downtime, though.
No disagreement from me.
I guess you could say we need to do a better job with mental health risk management.
Well, look at you creating a segue into the subject of today's podcast.
Every once in a while, it works.
Okay, well, that one did.
All right. So, on that note, today's podcast is all about risk management for rental properties and how landlords can reduce or transfer risk away, leaving them feeling, well, I guess you'd say more secure about the rental properties that they own and operate. Risk management runs the gamut. It can be financial, where you're analyzing your profit and loss or comparing how well your income covers all your expenses. Other ways to avoid risk involves personally working with the tenants and how you set up your business structure or the types of insurance that you carry on the property. And we're here to talk about all those things today, so let's get to it.
All righty. By definition, risk management is the process of identifying, assessing, and minimizing the impact of risk. In other words, it's a way for rental property owners to identify potential dangers and threats and then take the steps to eliminate or reduce the chances of them happening. Now, we're going to begin with the financial side of risk management. From the start, you have to know your numbers. So, what exactly does that mean? There are often so many different numbers that can make or break your real estate investments. Let's start off with cash flow. You own rental properties to make money, so cash flow is a huge proponent of risk. What metrics do you use to measure how well your property is cash flowing? Common ratios for rental properties are rental return or rate of return. Now, this is a pretty easy one. It's gross rents divided by the purchase price plus any renovations you've completed. And this is where the 1% rule comes into play. Say you earn gross rents of $6,000 and you paid all total $500,000 for your rental property. The return on that is 1.2%, so you've exceeded the 1% rule and should be okay. Cap rate is something you see often on sales pages and disclosure statements when looking to buy a property, but don't rely on it. Where it can assess potential profitability, it's used more commonly in commercial real estate than residential rental properties. So, to calculate the cap rate, take your net operating income divided by purchase price and renovations. The problem is what the past operating expenses may have been may be very different than what your new expenses might be. They might not account for reserves. Their insurance rate may have been grossly undervalued or not updated in many years, and a new policy for you might cost much more. Property taxes are another one. In many states, property taxes don't increase until the property is sold and the new value is assessed. It also only looks at the property itself and does not take into account if you have a mortgage or not, as it's only annual expenses less mortgage fees. So again, this is why previous owners' cap rate may be very different from what your cap rate may be.
Yeah, and I gotta say, for us, it's pretty annoying when realtors use this number as a selling point. It's so misleading to show what the current cap rate is and not include a pro forma one. Only experienced investors will look past that when they see it on an ad. Net operating income, or NOI, measures the profitability of an asset or an investment after subtracting operating expenses from income. It's calculated as gross income minus operating income expenses. And your operating expenses would be such things as property taxes, insurance, maintenance and repairs, utilities, other business expenses like HOA fees, property management fees, legal or CPA fees, and your cash reserves are expenses as well. Notice how the mortgage fee is not included when we talk about operating expenses. They're not considered a traceable fee, so they're not included. Some investors may sink a bunch of cash down on the deposit. Others finance the whole amount. So the numbers are not an accurate comparison to other metrics. ROI, or return on investment, is another ratio commonly used, and that would be revenue minus operating costs, and this includes your interest and all that for your mortgage, divided by acquisition costs. So this is evaluating your return on how much the investment costs you to operate it and does include the mortgage fee. So again, operating expenses means there's no mortgage amount attached to that. Operating costs do include the mortgage. Another way to measure risk would be to calculate your vacancy rate, but that requires one to estimate the number of days of vacancy that you're going to have, and that's really hard to do. There are so many unknowns to consider that we, as small investors, do not use this one.
Yeah, I mean, if we had several hundred units, then that's a ratio we'd need to follow. By using financial ratios and metrics, it allows you to set goals for your real estate portfolio, define how you measure success, because let's face it, it's different for each and every one of you. Make comparisons between properties you own and the ones you're looking to acquire. And bottom line, using these metrics will help you be more confident about your rental property business. They tell you if you're on the right track or alarm you that changes may need to be made.
Yeah, one tip we hear varying opinions on is whether or not to consider appreciation when you're researching your next rental property purchase. Many advise newbie investors to invest for cash flow and not for appreciation, and we agree with that. You invest to make money every month, not to break even with the hopes of someday earning enough equity to pull out cash and buy more investments. You want to look for both cash flow and appreciation value. However, as we get older and have more investments to carry us, we might consider investing for appreciation to help offset the income that we're currently earning, especially if it's in an area where one of our kids is living and allows us the opportunity to visit them, and then we can expense off part of the travel. But hey, that's for people with a lot of doors, not a horrible goal to have. Here's where you need to use caution when banking on appreciation. You should pay close attention if buying single-family homes in neighborhoods or areas without strong economic growth. Look for areas with large corporations, medical facilities, educational institutions, or military bases. You usually can't go wrong with investing near a state capital where government offices and jobs are plentiful either. And we know this firsthand with our sixplex in Sacramento, which is 1 mile from the capital. Many of our tenants have worked in government or related jobs, and job stability means competitive rents and a large pool of applicants to select from. Is this always the case? No. I'm sure many rental property owners who owned in Detroit did not have the foresight to see that the automobile manufacturers would be drastically cutting jobs when robotic automation came on.
I guess that's why so many are worried about AI replacing tech jobs. Will it impact job security? Not likely, but it will enhance jobs, making workers smarter and more efficient, allowing time to take on more tasks. Along these same lines, when searching for your next investment location, avoid low-end rentals. These places only look good on paper. What you may not consider are the additional expenses of theft, vandalism, or evictions, as the quality of tenants may be less desirable. Higher-risk tenants aren't just a risk for rent defaults. They also pose a higher risk to your property itself because they have little or no financial investment in it. If you upset them, there's a higher chance they'll trash your unit. Now, don't get us wrong. There is absolutely a niche for low-income and Section 8 properties. We just don't recommend that's where you start unless you have a deep understanding and familiarity with how to handle these type of properties. Cash flow management is a huge proponent of how you can increase or decrease your risk when owning rental property. Our next way to avoid risk is to understand the importance of cash reserves. For cash flow, you want to focus on building a healthy amount of cash reserves so you can pay for unexpected or large expenses. Typically, cash reserves cover such things as vacancies, late or unpaid rents, maintenance and repairs, seasonal or irregular expenses, insurance deductibles, and capital expenses like a new roof. They should also, at minimum, be reserved for large expenses like property taxes and insurance premiums. We did a podcast all about cash reserves where we discussed how much you should set aside and other options rather than taking from monthly income. It's episode 28, and we'll link it in the show notes so you can go back and check it out.
Another component that decreases risk is rent diversification. So the risk of rent default is highest when you only own one single rental unit. The more units you own, the lower your risk because the chance of all your tenants defaulting on rent at the same time is reduced as the number of units you own increases. Owning more units smooths out portfolio cash flows because one that might be struggling can be held up by another that's doing well. It also helps you weather economic downturns like the one we all just experienced with COVID-19. How do you diversify your portfolio? You want to own more than just a few properties. You want to invest in different geographical areas. So if one's hit by, say, a natural disaster, an economical downturn like a closing factory or a large employer or government facility closes or moves locations, not all your properties are going to be affected. Add income by adding more revenue sources like pay for parking, coin laundry, and storage units. Lastly, invest in different kinds of income-producing properties. If you're someone who only owns single-family home rentals, think about investing in multifamily. Or if you have a lot of residential properties, consider investing in commercial buildings as well. Warehouses, storage facilities, and mobile home parks are all known to do very well.
Okay, a couple more points on how numbers can impact your risk. When you are budgeting or looking for your next investment, use conservative estimates for expenses. It's so easy to get excited and starry-eyed when you first evaluate a property. Believe me, we've done this too. But it's important not to fail at adequately forecasting your costs like property management fees, vacancies, property taxes, repairs and maintenance, insurance rates. This includes liability, umbrella, and maybe even default insurance. All the other expenses we mentioned earlier like legal, CPA, and HOA fees. Expenses on average come to about 50% of rental income, and you need to account for these first and then deduct the mortgage. And remember, just because some of these expenses do not occur every month doesn't mean they do not need to be accounted for.
Yeah, that's exactly right. Legal and accounting fees are a huge number for us each year. We have reserves for those, just like vacancy, capital expenditures, and taxes and insurance. So let's say someone earns $6,000 a year from one rental property, and they set aside 5% of that rent for a new roof that they know that they need in a few years, another 5% for vacancy, and then they also set aside for taxes and insurance amounts. What they don't count on are the fees for their CPA to do their income taxes of $1,800 or legal fees for advice on how to handle that botched renovation that ended up costing them another $2,200. So they estimate their cash flow of $6,000 a year from that rental property, but then have to pay $4,000 of unexpected fees, knocking their actual income earned down from $500 a month to $167. Which leads us back to the beginning where we said, know your numbers. It also supports our suggestion to diversify your portfolio because the income from additional properties will help offset administrative expenses.
Hey, we've been there, you guys. In the beginning, we underestimated expenses left and right while we were learning the ropes. The last financial risk we want to address is to be mindful not to over-leverage your property. We see a lot of investors online telling us, hey, I bought this property using other people's money. And that's a great strategy for highly experienced investors. Over-leveraging a property likely holds the biggest financial risk for those new to the real estate investing world. This is where we circle back to cash flow and making sure your numbers are really solid before you borrow from a bank, and then also a family member or a hard money lender for the down payment. You need to consider balloon payments to these hard money lenders. If you do not gain enough appreciation to refinance and pay them off before the balloon payment, you're going to lose that rental property as well as ruin any chance of borrowing again anytime soon. Think about all those people who borrowed from hard money lenders over the last few years. They might have balloon payments coming due in the next couple of years, and where they have probably gained the appreciation, the rates are so much higher now that the cost of refinancing to pay off that balloon payment will leave them with little or no cash flow. And do you think a bank's going to lend on that? Not likely. They'll be forced to sell that or another property to fulfill those debt obligations.
Yeah, so if you're lacking cash and you want to start investing, consider house hacking. For those of you unfamiliar with this concept, it's when you purchase a home and rent out part of it, like the unused bedrooms, to earn income that will offset your mortgage payment. The perfect scenario is to buy a duplex or a triplex for you to live in one unit and rent the other units out to compensate for the cost of owning the building. ADUs are a great option as well. Convert a garage, a basement, or a space above that garage into a rental space and rent it out. All right, now we're going to switch gears and focus on your physical rental properties and the tenants. Think about it. Those two things likely hold the most common risks. And let's start with the property. The best way to protect yourself and your property from risk is to transfer that risk by way of insurance. Obviously, as a property owner, you pay premiums to the insurance company in return for the insurance company covering costs of large negative events, also known as, quote unquote, the bad stuff you can't afford. We'll touch quickly on a few different types of insurance landlords need or should consider, but for a deeper dive into them, check out episodes 20 and 21, where we talked all about insurances that rental properties can benefit from. And we'll link those in the show notes as well.
Now, the most common insurance policy would be rental property insurance, also called landlord insurance. It covers the structure and other structures on the property from such risks as a fire or storm damage, like from a falling tree, stuff like that. It also covers the owners from liability should someone get injured on the property. There are additional riders you can tack on for additional coverage, like flood, earthquake. I think now wildfire is a part of that for some areas too. In the insurance podcast, we discussed how to handle insurance if you are house hacking. So again, we'll link those episodes in the show notes if you'd like to learn more about that. Umbrella insurance is the next most popular option for rental property owners. We absolutely have these policies, and you should too. Here's why. It offers an additional layer of liability coverage above and beyond the coverage in your standard policy. Umbrella insurance can cover legal and medical expenses or any damages from injury to other people who you are found legally liable for. Here's a simple example. You have a walkway with a section that is raised up from a tree root next to the pathway. A guest of the tenant is not aware of it, trips, breaks their leg. They require multiple surgeries to repair the break and sue you for damages because their employment requires them to drive, which they cannot do with a broken leg, and they lose their job. They also sue for $1 million for the stress this has caused them and their family. Now, most rental property insurances will only cover you from between $100,000 and $500,000, but any amount over and above that, plus the legal costs, would be covered by your umbrella insurance. The last thing we will say about umbrella insurance is that it's relatively inexpensive. I think we pay around $800 a year, but that's for an additional $5 million in coverage.
Yeah, I mean, if you think about it, in the scheme of things, that's really not much at all. All right, renter's insurance is a must. This is insurance that your tenants carry to insure the contents of their unit, as those are not covered by your rental property insurance. It also covers you for a small amount should an event like a small kitchen fire be the tenant's fault. We require all tenants to hold renter's insurance with a minimum $100,000 liability and name us on the policy as an additional insured or as an interested party. So, interested party means that the landlord has a financial interest in the renter's insurance policy, which basically just means this is who the insurance company is going to pay for anything that that tenant is found liable for. Additional insured, on the other hand, means that you, as a rental property owner, is also covered by the insurance policy that the tenant has purchased. And this one costs the tenant a bit more and should be clearly noted in the lease that this is required. And here's the deal. If you don't require it, or you want to request your tenants carry renter's insurance, we recommend the company called Toggle. It's a small subsidiary of Farmers Insurance, and they offer super reasonable rates. I think their cheapest policy is like $5 a month. Their policies are customizable to include such things as coverage for a home-based business that a tenant might operate, or expensive collectibles that they might have in their unit. We have a PDF that you can send out to your tenants that's very helpful. Just download it and send it out to your tenants in an email, and we're going to link that in our show notes for you.
And at some point, we're going to be doing a whole podcast on why landlords should require tenants to have renter's insurance. But if you're interested in learning more about that now, we wrote a blog all about it. We'll also link that in the show notes. The last one to help landlords avoid risks is to purchase rent default insurance. If your tenant stops paying rent, the insurance company starts paying it until the eviction process is completed. Now, evictions can take months and in some cases just shy of a year, so that's a lot of income to lose. Like umbrella policies, the premiums are low cost and reduce risk of lost income. There are a few companies that cover for rent default now, but always check with your primary insurance provider first to see if this is a rider they can add on to your existing policy. So we've talked all about how you can transfer property risks by way of your insurance policy. Now let's discuss more preventative measures to reduce risks. You know, the number one thing on our list is going to be performing inspections and preventative maintenance. We recommend you go in your units every 6 months to inspect for damages, violations, potential hazards, and maintenance issues. This keeps the tenants on top of things and helps you know how your unit is being cared for. One of the very first episodes we put out was all about the importance of rental property inspections. I believe it was episode 4, And please, if there's only one episode you listen to, make sure it's that one. It's a lot of great information, and we'll link that one also in the show notes. But the gist of it is this. This inspection is an opportunity to check for small leaks under the sinks and toilets, look for preventative maintenance issues like dangling tree limbs or raised sidewalks like mentioned earlier. It also allows you to check on appliances that may need replacement soon.
Yep, which leads us into our next tip on reducing risks associated with tenants, and that is to use incentives to increase tenant retention. When lease renewals come around, you run the risk of that tenant moving on, forcing you into a position to lose time and money while turning a unit. So during those inspections you're doing, if you notice something in your unit is getting worn, like appliances or light fixtures or the bedroom carpet, you'll know that if the tenant does not renew their lease, these are items you're going to need to replace anyway. As an incentive to renew their lease, let them know that they can either choose, or you just tell them, hey, you're a good tenant, we're increasing your rent a little to keep up with the market, but we're going to install new appliances or replace the carpet in all the bedrooms if you renew your lease. This makes the tenant feel like they're valued, and you get to keep a great tenant for another lease period. You can also help to retain your tenants with good communication, remembering them on special occasions and during the holiday season, and performing maintenance before it becomes a problem and impacts that tenant. These are all things that will help your tenant feel valued and important, because when it comes down to it, your biggest risk is with that tenant. And do not underestimate this risk. If they are a good tenant and pay their rent on time, respect your property, and follow all the rules in the lease, they are worth working to keep on. The most time spent and money lost for landlords is replacing that tenant.
That is exactly right. I feel sometimes landlords forget the importance of their tenant. So let's say you're in the unfortunate position where your tenant is not renewing the lease and you are stuck having to replace another one. As stated earlier, your tenant is going to be the biggest risk you have. Who you place in your unit will determine your income, the care of your unit, and if the terms of your lease are going to be followed or not. Let's start with your lease. You need to make sure it is ironclad. While you want to make sure your tenant feels valued, it is also important to set boundaries so that you're covered for any and every little thing that can occur in that unit. Our lease for our California properties are 37 or 38 pages, and for our Idaho property, it's 32 pages. Again, we just finished a 3-part series where we break down our California lease section by section and let you know all the clauses and addendums you should be considering at a minimum for your lease. We'll link those in the show notes, but it's the last 3 episodes prior to this one.
So tenant screening is the next big thing that you must give your utmost attention to. When creating criteria, make sure you're abiding by local and state landlord-tenant laws and also federal fair housing laws. And follow the same procedures for each applicant. Make sure they complete an application and sign it to authorize you to speak to others and pull that credit report. Do thorough background checks and use an approved consumer reporting agency so you're sure to be following the Fair Credit Reporting Act. Verify their employment and speak with the last couple landlords to see if there was any issues. Check for evictions and speak to their personal references. Now, we don't mean to fly through this section, but we have podcasts on the books as well as a course coming in 2024 that's going to cover all of this. And if you'd like to learn more about that beforehand, you can check out our free resource. It's a 10-page guide on how to place your ideal tenant. It goes over criteria, preparing for your unit, marketing, vetting the applicant, your lease, and move-in procedures. It's got a lot of really good information in there, and you cannot beat free. So we're going to link that in the show notes for you.
The last point we want to make to mitigate risks with tenants is to stay on top of communication and to document. You want to encourage tenants to let you know when something needs repaired or needs attention. You also want to respond to their requests quickly and professionally. Let them know you are sorry they are experiencing this issue and that you will either handle it yourself by X number of days, or you will call a repairman and let them know when they can be by to evaluate it. Communicate every step of the way so they know you're staying on top of it. This will let them know they are important and that their time and well-being is valued. And one quick tip, when using service companies or contractors, do not use your cousin's boyfriend who's pretty handy. Make sure they are licensed and insured. And just don't assume they are because they list a license in their ad. Check it. We have found a couple people who had let their license lapse and didn't know. Using unlicensed and uninsured contractors adds a huge risk to your rental property business. If there's an accident or their work is not done to code, or they damage another part of the property when working and they are unlicensed or uninsured, you are liable for that. And no, your rental property insurance does not cover you because you unknowingly hired an unlicensed contractor.
No, they do not. All right, you guys, we're almost done. The last thing we want to address is limiting your liability with legal structure. So, how you set up your business can reduce or prevent risk to you on a personal level. If you own multiple rental properties, you should keep them all completely separate. Because if you have all of your properties under one business entity, they are all subject to risk if you have a legal issue with just one of the properties. The most common way to structure your business is an LLC or limited liability company. It protects you personally from debts that occur on behalf of your business. An LLC will also grant you privacy because you're operating your property ownership as the name of the LLC, not your own personal name, which is more of a benefit as you scale and grow your portfolio and eventually use professional property managers to run the daily operations of your rental property investments. If you'd like to learn more about whether an LLC is right for you, check out episode 16, where we talk in depth about the pros and cons of holding your rental property in an LLC, and we'll link that in the show notes.
So we are coming to the end of the show here, and we hope we have showed you the many different ways to mitigate risks that can occur with owning rental property investments by 1, preventing negative events from happening in the first place, 2, by reducing the impact of negative events when they actually occur, and 3, by transferring the financial risk of negative events by having a solid, comprehensive lease and utilizing your insurance companies. And this may all sound like a lot, but you have control over all of the risks we have discussed here today. All investments have some level of risk, but with rental properties, you have way more control over those risks than, say, investing in stocks. Not to say stocks are a bad deal, they are definitely not, but you have much less control over the market or whether a company has extreme losses than you do by investing in real estate.
Yeah, so let's get something straight. You're going to make mistakes, and hopefully not expensive ones, but you're going to learn little by little how to avoid and mitigate risk when owning rental properties. Get help where you can. Network with other landlords. Listen to our podcast and read our blogs. Employ a great team to work alongside you in your rental property. But take the time needed to learn the business. You certainly can hand management off to a property manager, but you are still the owner and operator. You still need to be in control of your properties and evaluate the risks. You are in charge of whomever works for you, and you are responsible for anyone living in or visiting your property, not the property manager. It will be really hard to grow and scale your rental property business without, well, knowing how to run that business first. All right, I'll stop. And, we just want you all to succeed. We want landlords to know it's a lot of work, but it's so rewarding. And the sooner you get going with running your rental properties professionally, the sooner you can scale and reach those financial goals that you've set for yourself.
Okay, so let me jump in here real quick and let you know we're going to be doing a Q&A podcast soon. So if you have any questions for us, please email them in. We'll link our emails in the show notes.
Yeah, we've gotten some really good ones, but we can use a few more. So don't be shy. Email us any landlord questions that you got. And lastly, if you like what you've heard today, please follow us on your favorite podcast platform on Instagram and share our podcast with other landlords. If you could leave us a review, that really helps us reach more rental property owners who want to learn the way as well. And lastly, subscribe to our newsletter, Landlord Weekly. When you do, we send a few of our most common free resources, plus you get a weekly email filled with tips, landlord-specific articles, and the link to this podcast. We'll link all the ways in our show notes. Thanks so much for tuning in today. Kevin and I are humbled by how many of you are taking the time to listen to what we have to say. So until next time, you've got this, landlords.